Welcome to the Broken Chart Pie Chart Podcast, episode 355. I'm your host, Derek Moore. With me again, Mike Snyder and Shane Skinner. All right, so nothing really to talk about this week. We can probably end the show and be done with it, right? Like, oh wait, the Fed. The Fed did do something this week. And Mike, I'll go to you first. Did anything change?
No. No, I mean, we've talked about how there really haven't been surprises with Powell. He has, pretty much stuck by what the market has expected them to do, and that wasn't any different here.
I mean, I guess the only thing on the periphery, there was some stuff about liquidity for bonds, and I don't think they're necessarily easing, but I think they're gonna do some stuff to make liquidity better. I got to dig into that a little more. I mean, the 10-year really didn't move that much, although we wouldn't expect that because, of course, they're affecting the short end of the curve. But then you have stocks today. I mean, they got what they wanted, Shane, but stocks were a little iffy today, although maybe that was the Oracle news.
Oracle and AVGO both, I think, sort of spooking the market a little bit. If you look at the Mag 7 in general, most things were down today. Apple held its ground better than I think any other name. Did close positive. Google did close negative. Everything else, I believe, negative. Tesla up as well. That's been kind of a quiet one lately. Haven't really.
Why is Apple, Shane, so resilient? Like, Apple just has not budged recently.
I mean, I think you and I were looking at it a couple of months ago. They've still got a lot of cash flow. I've not heard of them taking a ton of investment and shoving it into AI yet. I think we've said this before. I think they've sat back. So, they also just seem to be a defensive stock within the Mag 7 in a way. I don't know, looking at historical vol on stocks, whether they're lower or higher than anybody else at this moment, but I don't know. Apple just seems to be something that people go to in times of uncertainty without leaving the market.
Mike, I wonder too, like, imagine this wasn't AI. Imagine, and I lived through this period, it's the internet. Just because you weren't building your own web browser or your own whatever it is, servers or routers or whatever the heck else, what Cisco is doing. Like, imagine you have a company back then that didn't invest $1 in the internet. Eventually, they got to enjoy that technology for nothing. I mean, there was implementation, but Mike, there's a world where all these model companies, the OpenAIs, the Anthropics, and all of them, they're spending all this capex. You have the other Mag 7, I mean, Meta, Google, they're definitely spending. Is there a world where Apple just sits back and is like, yeah, we don't have to spend a dime. At some point, there'll be booms and busts in this, and we'll either pick somebody up really cheap or this stuff will just be available and we'll just use it. I mean, maybe they're the smart ones in the room. I don't know.
Yeah, I think, they could sit here and let this all shake out and figure out how to best use AI and where to get that technology from down the road. I mean, that's sort of been what they've done historically with a lot of products. They haven't been always the first, but they have perfected it and found the most user-friendly way to incorporate it into all of their products. So that could certainly be a path that they're going down, which would make them more defensive, because it seems like right now you say AI and the market sells off your stock. Like, there were, I think, was it Broadcom's earnings? They had great earnings, and they have, they're expecting chip sales to continue to grow, but the AI trade has not been a great one recently.
I'm always thinking about, with Apple, Microsoft, I think it was after the iPod came out, but Microsoft came out with a Zune player, Zune. Do you guys remember that one? Probably not, because it's it flopped for all intents and purposes, not around anymore. Like what Apple did really well was the iPod. I mean, yeah, the iPod was a great device when that came out. And the ability to watch movies on it once it did video was incredible. I had one when I travel all the time. I would watch movies. It was fantastic. But it was just so easy to use. Like it was so easy to get your music on it, so easy to buy stuff, to put movies on it. And I don't remember that same ease and something like, I mean, I never owned a Zune, but people who owned it, I'm like, it was a pain in the neck to get stuff on there. So maybe it's early and Apple is the smartest person in the room, or maybe they just figure if we can't do it the best, we'll just sit back. Like I don't know what's going to happen to Apple. If you own Apple, I mean, do you want to keep owning it? Own it. I mean, we actually hedge. We have people who we hedge big positions in Apple to hedge the downside because they like the stock, but they just want to protect. Some people want to generate income off it. We do those things for people, but I don't know, Shane. It's sort of telling because Apple underperformed, and now it's performing. And Google, by the way, wasn't Google down? Weren't they down like 30-40% at one point?
Yeah, talking about April lows,
Yeah.
the whole Mag 7 in general, market in general, that April move was a bit scary there for a second. And just the recovery, the V-shaped bounce, right? It's this has to be historical in some manner. Like I don't have the data. I know that there was one day in April, right? I think it was the largest amount of points moved up, or it made top something in the list of movements in the index in a single day to the upside. So it's been a really crazy year, and I think it's been proof that you never know what's going to happen. It's why hedging is something that you know we seem to like to do, right? And at the same time, you never know when the market's going to recover, how quick it's going to recover, and if you stay out and you're not patient, you can end up missing. There's been a lot of cash, I think, that's still on the sidelines. People waiting, saying like, when is the right time to get in, right? You talk to a lot of people, I'm sure, that have
Oh yeah, no, there's definitely money on the sidelines, and part of it is we see it in the sentiment numbers, and it's changed because Trump is in office now, and there's a lot of people who feel like that's bad, and they don't know why stocks are going up. 4 years ago, it was the same thing, but only it was Biden, and other people were like, I can't believe stocks are going up. There's going to be a depression. So I don't know. Thinking about valuation, I pulled up. Let me see if I can pull this up. Nvidia, and I looked at the forward PE, and its forward PE is dropping at the same time its earnings expectations are going up. So think about it this way: Nvidia is higher than it was. If I go back to June of 24, and Nvidia was like, I don't know, 135 or something like that. Its forward PE was 42, 43. The forward PE right now is like 24.8, 24, something like that. I'm kind of reading it off to the side here. So you can imagine if you're looking at a chart of the forward PE ratio and you're looking at a chart of NVIDIA, as NVIDIA has gone higher in price, its forward valuation has dropped because the earnings estimates are rising. So, Mike, we've seen a lot of these stocks almost consolidate. I think if you look at a chart of the S&P, there's some consolidation right now. We'll see if it breaks out or breaks down. You look at the Mag 7, I think there's consolidation. And even in, NVIDIA and Microsoft, and really Apple's the one that's near its all-time highs. It's kind of acting a little differently. But Mike, like stocks on a valuation basis are actually cheaper now. It doesn't mean they'll go up or down. It just means they're cheaper.
Yeah, they're cheaper, right? I don't know if we would say that they're cheap, but they're cheaper. And it's really just, I don't know. It's sort of like they're out of favor at the moment, and the market's just willing to pay less for those future earnings than the market was willing to previously. Apple sort of was the one that was lagging from that April sell off, and it had been lagging, and it's just finally caught up, and it's more that other stocks have come back to it and started to form that consolidation, like you said. So right now, the AI trade is just, and when I say recently, it's, last couple of weeks, it's just gone out of favor a bit temporarily.
All right, I want to switch gears and do a little personal finance stuff. So, one of my clients sent me an article from Yahoo News, and it was a 20-year-old lottery winner decides against taking a $1 million lump sum. Looks like this person is in Canada, opts for lifetime weekly annuity in hopes of buying a home. So, the article says Brenda Oban Vega was on a break from work when she scratched a Gagnant V, I'm trying to call him my high school French, ticket and became a lifetime winner. The 20-year-old, so she's 20 from Montreal, uncovered three piggy. All right, none of this matters what it scratched off. So $1,000 a week for the rest of her life, or she could take $1 million up front. She is 20. She took $1,000 a week for the rest of her life. So it's a little bit of a personal finance thing. And if you look at this, you would say, we don't know what her tax rate is or anything like that. So let's set that aside. But Arizona, so what's the top marginal federal rate? It's 37. Arizona's 2.5. We're pretty low. We have a flat tax here. So if I win this, and I'm not 20, certainly, but I'm going to lose 39.5%. So this is round up to 40%. So if I got the $1 million, I would get 600,000. So we'll just use let's assume, that's the numbers there. Or I could take $1,000 a week, so that's 52,000 a year. And of course, to be probably taxes on the income. She took $1,000 a week. Like, okay, so you could invest 600 grand today and assume you get some sort of a compounded return. Or you can like periodically invest $1,000, and let's just pretend that that's what she would do. I don't know, Shane. What do you think? And there's
I
multiple right and
calculated
wrong
it
answers
out.
here.
Yeah, no, I calculated it out. This is, I think, a deeper question beyond markets. Really, it's if she lives to 70, from 20 to 70, say, at that point she'd have collected about 2.6 million. It looks like.
Yeah.
And I'm sure she would have been taxed on that. I think you're right. Right, you're not going to avoid that either way. But I, in a way, she is investing. It's just it's like an annuity, right? And so it's, I don't know what $1,000 is going to carry or be able to buy here in 20, 30, 40 years, 50 years.
I mean, what you're referring to, Shane, it's not inflation adjusted higher. Like it's
Correct.
fixed. Yeah.
It's fixed, right? And so, if inflation runs, even if it just gradually increases, right? Eventually, the thousand's not going to be worth the same purchasing power as years before. And so, you could argue, though, depending on her lifestyle, right? Maybe she could make this work, or this is exactly what is needed. And depending on how she uses that money, that'll determine how far it goes and what she's able to do with it. And I'm with you. I know where you're going to go. Like, just take the money up front, get it invested, and by the time you're 40 or 50, you could be in a much better situation potentially, depending on the market's performance over that time period.
Mike, what do you think? I mean, I want to go at this a couple different ways, but I want your initial thoughts because I just sent this to you guys.
Yeah, there's, I think there's the book answer, and then there's sort of the behavioral part of all this that you can't really define with numbers. Getting $1 million or 600,000 up front, could be difficult to manage. It requires more discipline. Maybe, this is a way to sort of take some of that out of the equation, and just try to spread it out and invest it over time versus, getting a bunch of money at 20 years old all at once.
I don't know if you're familiar with the baseball player Bobby Bonilla. So Bonilla probably last played in the league 2006, maybe 2007. But he was playing for the Mets, and his salary was 5.9 million. So what they did was, or his 2000 salary was 5.9 million. The Mets came up with almost a discount rate. So the discount rate was 8%. That's sort of the assumed return that you discount the future cash flows back to. And what he did was he deferred his salary for 10 years. So this would have been from 2000 to 2009. His contract paid him nothing. And then 10 years later in 2010, it started to pay him 1.193 $248,020 a year for the next, I think it was 30 years. I got to look here. I think it was something like 30 years. So the total deferred salary in aggregate was 29.8 million, and his salary was 5.9 million in 2000. So people are like, oh, the Mets made a crazy deal. And maybe that's true. And quite honestly, the owners, I think, put some of the savings into who's the guy who did the Ponzi scheme? Why can't I remember him?
Bernie?
Yeah, Bernie Madoff. I think they invested some of
Oh, brilliant.
that. But this reminds me of that. It really does. Like it's kind of like a deferred outcome. And Bonilla, by the way, they call it Bobby Bonilla Day because he gets paid like once a year and he lives in Florida now. But yeah, he gets paid through 2035. So 2010 to 2035. So that's 25 years. He gets about 29 million versus a $5 million. And I remember running the numbers on this. And it's like, if you assume that he took the lump sum after taxes he would have gotten in a salary versus this, it's pretty close on the investment side. So I don't know. I don't know why I remember that, but you guys can Google Bobby Bonilla Day, and there's deferred contracts. So I don't know, Mike. I think to your point too, it's not an easy answer. Like, who knows whether if she got the lump sum, whether she would actually spend most of it down anyway. I think that's the tough part.
Yeah, a lot of it, like if you talk about buying a home versus renting a home, some of the things that you save on when you're potentially renting, you have to actually invest that, right, for that math to make sense.
Yeah, I didn't do the present value calculation, but by the way, Bobby Bonilla, his 29.8 million in payments he will receive from 2010 to 2035. The present value of those payments in the year 2000 was 5.9 million. His 2000 salary is 5.9. It's the exact same thing from the present value. I guess, Shane, the other part of this too is that she may not invest $1,000 a week either. She'll
No.
probably spend that.
No, probably does. Probably uses it for bills, or I mean, whatever she chooses to use it for. At the end of the day, I could also see, being 20 years old, especially if you're someone if you are financially literate, then maybe there's a different approach you have. Maybe she is financially literate and still felt like this was the better decision for her personally. Because she is worried if she was given that much money, she might do something irresponsible with it, spend it all on whatever it may be, right? And so I can respect the choice from the standpoint of it probably made more sense to her in the moment to take money once, a week, right? Annually for basically the rest of her life. Guaranteed income, that's something most people don't have. And given she probably continues to work a job, hopefully saves for retirement as well. We'll see. But
The person who passed this to me said it's kind of like she got double Social Security at 20 instead of having to wait to 67. This woman's in, it looks like, Quebec. which is Canada, which is different than the US. I get it, but we're just kind of doing a hypothetical here. And my answer was, well, that's not necessarily the case. Yes, for in the current period, but inflation gets indexed up. Not Social Security gets indexed up based upon inflation. So you get your benefit rises over time as inflation. You know, I mean, if the median sort of Social Security is something like 17 grand to 20 grand right now, I mean, 20 grand, if you get about, you know, 2.5% inflation over 20 years, that benefit should go to about 32. So I don't.
That could be
Here's the other.
groceries for the rest of her life. That could be groceries for the rest of her life. Maybe that's how she views it, you know? And you can't necessarily blame her for something like that. For depending on who she is, where she's from, the situation she's in, you know?
No, I think you're both right, and what you're saying is that it's not necessarily a spreadsheet answer. Like I could run the numbers and say this is a bad decision versus a good decision, but it actually doesn't matter because you also have the lottery winners, quote unquote, problem here where, and I think this has been debunked, but there was a claim that 70% of lottery winners wind up going bankrupt. I think that research has been challenged. NPR had an article that said a third of lottery winners wind up, you know, spending their money down to zero. And part of it is they've never had assets before. So quoting Nick Majuli, who the Wealth Ladder author who I had on the podcast, I'll link to that episode. People really like that episode. He had kind of made mention of the reason why people have permission to spend money later is because they've spent a lifetime building and saving, so they already have the discipline. So I'm trying to see if in this article. Yep. So according to this piece, while most lottery winners take the lump sum, opting for the weekly payout can add up. At $1,000 a week, it would take 1,000 weeks or 19 years to reach $1 million. Okay, I'll trust their math for now. If you were to invest the weekly payments at a 5% growth rate, it would take about 13 years for a future value of 1 million and about 21 years for 2 million. All right, I think we beat this up enough, but it's just an interesting question. It really is, because and I'd have to do the present value calculation on it, but I believe when you have a lottery winner, and I think I've done this, it might be years ago I did this on a podcast, where you did the present value of the cash flows over time, and it kind of is the same thing as the tax equivalent lump sum. So I don't know, Mike, any other comments before we move on?
No.
Shane, anything?
No, I think we've beat that one dry.
I'm fascinated by this. Like, it's a total personal finance question.
No, I mean, it's the human factor of all this, the psychological factor. I'm not going to get into behavioral economics.
Look how happy she looks in that picture. She's holding up the check.
Listen, like, again, that's what I'm saying. This is where it gets into the human factor. It all depends on who this person is, where they're from, and what their experience has been throughout life and who they know. It's going to make a big difference to the average person. And, you know, if this is
I am
bookmarking
this article because if I ever get around to writing my personal finance book, there should be a chapter about this. This is interesting. Okay, let's move on. What else let me pull up my list here. All right, let's cover next year. S&P 500 targets for 2026 are coming out. Sam Rowe had put out a tweet on this, and also it's in his Substack as well. And the estimates range from 7,100 for B of A. And so basically they're saying, here's my target. I believe this is for year end 2026. So what is the market going to be worth? They're the low, according to these, they're posted. I've seen lower ones though. 7,300 from Societe Generale, 7,400 Barclays, CFRA, 7,500 UBS, HSBC, JP Morgan. Goldman's at 7,600. Yardini and Fundstrat, 7,700. Let's see. RBC, 7,750. Morgan Stanley, Wells Fargo, 7,800. Deutsche Bank, Capital Economics, 8,000. Oppenheimer, 8,100. So 7,100 from here is what? It's 7,100 divided by 6. We'll just round down to 6,800. So, you know what, 4.4.5%. If we get 8,100 from here on the high end, it is, it's about a 19% gain. So
it's a huge range.
Yeah, I actually give them credit that there's usually they cluster right around a quote unquote average, although we never get the average. So, Mike, if you're putting money down right now, who do you think is right here? 7,100 or 8,100? We'll make our predictions in 2 weeks, I think, is when we're going to do our prediction show.
Well,
so
I was going to pick the middle.
Very brave of you. Yeah.
No, I mean it's fun to look at these, and it's a tough job that they have coming up with their targets, and we see that throughout the year these will change as the market moves. So, and I'm surprised how big the range is, though. That's my first thought.
I mean, 4.5 to 19%. That's pretty big. Shane, what do you think?
Someone's gonna be right, or everybody's gonna be
all
wrong.
right. Come on. That's lazy. Come on.
I mean,
I haven't made my forecast yet.
I could see either or. But realistically, I don't know. I kind of want to say I'm further to the upside than I am the downside. I can't believe that's coming out. I can't believe I'm saying that as someone who's constantly worried about everything in the market, right? This thing has just continued to run.
I am curious if I can find it. Let me see. So, yep, I believe this is. So my prediction, this is funny. End of year, 6,800 is what I had. I had us touching 70-30, but I had us ending the year at 6,800. So I haven't obviously hit the high yet. We haven't crested 7,000. We are right around, like if the year ended right now, I would win based upon everyone else's predictions. So, but we'll get into this in the prediction show. So, look, I think where I am is it's no surprise that people have positive forecast because the market's been up. And when the market's up, you tend to see that. When the market was down, you see them being more bearish. I will also say I don't think the investment banks are changing what they're doing based upon a strategist opinion. And Mike, you said these are fun to look at. I don't think they're particularly helpful. And I think they're very hard to do. And it's not necessarily actionable. Like if B of A said the market was going under 5,000, do you sell all your stocks if you're a B of A client? I don't think they're going to do that. So
do it and then sue, right? That was advice from B of A apparently.
No, I mean nobody should take these advice.
No.
But it's so then 314 Research, which is Warren Pies, he had something on Twitter, and his executive summary of their 2026 outlook is 26 is a recovery year, 18 months post bear market. In these periods, returns are higher and drawdowns are lower than typical. H1, I imagine that means first half, enjoys Goldilocks conditions, shelter, oil, labor, disinflation plus growth reacceleration. By H2, the second half, overheating threatens the delicate balance. S&P ends the year at 78.50 and produces strongest EPS growth since 2021. Oh, interesting. Commodities become new preferred portfolio diversifier. Yeah, okay. So Warren Pies, and I remember reading his stuff last year, and I think he had a good call in 25. So,
that's pretty much what the at the money SPX Straddle's trading at,
Is it really?
yeah, 78.50, 78.25, right around there.
And
I
then,
was gonna say RBC, Morgan Stanley, Wells Fargo look right around where I would if I had to be a betting man, and then sure enough, 77.50, 7,800. It makes
well,
sense.
when like 2 weeks, you're going to have to put your prediction on the record. Not that we don't trade off these, but I don't know if I told you guys that, but we do a prediction show, so you'll have to come up with your own. So, all right, I mean, I think these are bullish, and you go back to there's some data. This is from Charlie Bolello. He put this out on Twitter. S&P annual total returns 1928 to 24. Average annualized total return is 10%. Percent positive 73% of the time, or 71 out of 97 years. Audience can't see this, but this is a bin chart, or what do you call these? I can't think of it. Histogram, right? Where it shows between 10 and 20%, and they stack the years in blocks. And markets are between 10 and 20% the majority of the time, but they're between 20 and 30%. That's like the second most outcome. And between 30 and 40% is not that far behind. 0 to 10, that's in there, and minus 0 to minus 10. And then, of course, you have the outliers, like 1931 was greater than 40%. 2008, 1937, those were in the negative 30, negative 40. So, all right, I mean, yeah, markets go up over time. But when you look at these predictions, I think it's lazy just to do up 10%, because when markets are up, they tend to be up, as we can see here in this histogram chart. At markets are up. I mean, yeah, you could have 20%. We've had 20% years, Shane.
We've had, I mean, again, since my generation has really started investing in or trading in markets, talking late 20 teens to COVID era, um, I think we're almost like used to it. Like it would be weird for us to get a flat year or even, sub 10% up or down. It seems like I I don't know. I just feel like ever since COVID, it's sort of changed. Now I say that now, and of course next year we're only up or down 5% or less. Watch it happen, right? But you know, the market's shown, especially in more recent years, we're more than capable of moving greater than the 10% average, sometimes in the 20 to 30s.
The bear case here, Mike, is this year is like 2021. Where 2021, you had good earnings growth, you had high multiples, you had the markets moving higher. People said it's too high. There's no way price to sales can stay this high. Like, that's the bear case that we run so far so fast, and the trade that the basis for the move is definitely AI. Although I would argue that a lot of stuff is making all time highs, and that. But I mean, Mike, that's the bear case. Like, if I'm trying to make a bear case, and I'm not saying I am, I'm going to say, yeah, this is 21, where wherever we end the year, it's going to be the high for the next 1.5 years.
Yeah, so sort of like just market not willing to pay what it previously was, even though earnings are still strong. That type
Yeah,
of a market. Yeah.
sure, sure.
Yeah, I mean, we just talked about it with Nvidia being cheaper right now than it previously was. So I think that's all the things that I can imagine. That's sort of the most obvious bear case.
Mike, do you go with, so there's a little bit of a debate of whether you use cyclical bear and bull markets, or whether you use, peak to trough. And what I mean is, like, you would say in a cyclical bear market, you topped in March of 2000, and then I don't think you made a new high until, was it 2013? Because you had 2008 in there too. Although you would say that you troughed, you ran up again, and then you troughed. Where do you stand in that, Mike?
What was the other option?
Well, I mean, or just, you're like, oh no, we're in a bull market because we made a low, we made a trough, and now we're, X% off the low. or we're down more than 20%. Cyclical just means you have to make a new all-time high after a previous high.
I guess I would be in the latter camp.
Okay, so cyclical. And if that's the case, you would say that we have been in a cyclical bull market for a while. And that
Yes.
we're in a cyclical bull market, but 2022, was really just a pullback within a longer term.
Oh,
The
absolutely.
new bull didn't start in August of 22. That's kind of
No.
what you're thinking.
Yeah, that's how I would look at it. Thank you for finishing my thought.
Yeah, there you go. Shane, I mean, when you look at that, I mean, so let's say we're in a historical cyclical bull market right now, and they can last a long time. I mean, '09 to 22, I guess. Well, they have the Dow here. You have 82 to 2. So 82 to 2000 is the one, Shane, that comes to mind for me because I remember a lot of that period. But Shane, are we in the period now where this could be like 82 to 2000, and the pausing that we saw in 94 where things went sideways even though earnings grew 30%, or maybe 98 when you had the trouble in foreign markets? Like, is there a case that next year we have a pause and then it's a continuation of the cyclical bull market?
I mean, it would help out the averages for sure. I know we've got a picture somewhere in here in our notes for today, looking at annual returns, right? And
Mm-hmm.
I when just thinking about where the S&P is this year to date, as of the close today, the S&P 500 is up 16.34%.
Not
So
average, above average. Yep.
above average. Let's say we're looking at 10 to 11% average annual return, roughly, give or take. I haven't looked at it up to now, but yeah, this is 6% above average. So in theory, if we're just measuring that off with the upcoming year, something less than average would seem to balance that out. But I think it's way more to do with, does the black swan event have, like, what's the black swan event? Can you
Well, you don't know
predict
what
it?
it will be
No one ever will, right? And so
because
it's
it's
just
always something that no one's worried
no
about.
one ever, right? And what do they say? It's like, if you think you've got it predicted, you probably don't, right? Like, you can't play chicken little all the time, but at the same time, this is where I think this sort of conversation leads into the we don't know, right? It could go up significantly, it could run sideways, it could fall back big time. You want to be there when it's up, you want to have protection when it's down, and if it's sideways, well, that happens from time to time in markets. And there are other ways to explore generating income or growth outside of just stocks at that point, potentially. But you know it's where you never know, and that's where buying and hedging just seems to sort of provide that peace of mind before said black swan event happens. And if you're wrong, you paid a little bit for peace of mind and you're still participating in upside.
There's a chart of fears. This is from Carson, using FactSet, it looks like, Ryan Dietrich. And the chart of fears are the Dow Jones with major geopolitical events since 1900. And I didn't read the context on this, but I'll just take the context that I would take from this. And that's like, markets always have something to be worried about. Over the long run, they move higher. That's nothing groundbreaking. But what struck me though, I mean, we've had the San Francisco earthquake in early 1900s, the Panic of 1906, Spanish flu, World War One, crash in 1929, the Great Depression, Pearl Harbor, Korean War, 6 Days War, Watergate Nixon, Black Monday, Cold War, Chernobyl, taper tantrum, Ukraine, the tariffs, COVID, everything. And then what he does is he shows that over time this goes up. That is not anything that, I mean, everyone knows that. I think the message there is that, like, what you're worried about sometimes in the long term, doesn't really wind up being a worry. And sometimes it is in the short term. And somebody's time frame matters, because if you're retiring in 2 years, you don't want to have like a crash in 1929. What struck me though is, look at the top of the market before the 1929 crash, and then just move your cursor to the right. And if I'm reading this right, yeah, I mean, you didn't make a new all-time high in the Dow until what, 1956, 1957 maybe. So think about that, 29 to 57. And I don't know who invested at the very top, but in theory, if you invested at the top, it took you, 26 years to get back to break even. Obviously, you're trailing inflation at that point. So I don't know. I mean, Mike, that was striking to me, just to see this on a chart. And maybe the scale is mixed up, but I mean, in the crash of 29, I mean, it was worse than '08. So, you know,
Yeah. I mean, the '08, obviously the bounce back, and I think in sell-offs we've seen recently, the bounce back happens so quickly.
mhm.
I think, there's just much easier access to markets today than there was back then. But that's, I mean, we talk about lost decade of, 2000s. I can't imagine, if you did invest in 1929, waiting, what is that, 25 years to get back to even. I mean, that would be debilitating to people today, I think. With how many people are invested in the market, the average person with a 401k, that would, that would be tough.
Yeah, I mean, that's the thing. It's back then there were no 401k, Shane. Like this, no 401ks. It wasn't until I think the late 70s when Vanguard came out with the first index fund. It was very expensive to buy stocks, and it's really different today. So Shane, I don't know if I mean, this is obvious. Like we're not breaking any ground here. Like, yeah, markets go up over time. We don't know when they're going to go down in the short run or up in the short run, but like all of these things in the moment were a big deal. And given long enough, it's one of the thing. Like if somebody plays blackjack for the longer they play blackjack, the more the probability they'll lose money. But it's the inverse for markets. The longer you're in the market, the greater the probability that you'll be up money over time. So I don't know. Not
JP Morgan said, when asked about what the market will do, JP Morgan said it will fluctuate. That's,
that's
I
great.
mean, that's, I feel like about as to the point as you can be. And again, like we could go on and on about how the structure and the inflows, the 401ks, the pensions, people's retirements, access to investments, liquidity mechanisms, the Fed, like, it's Pandora's box if we're gonna go back from the 1920s till now and talk about how we got where we are now. But I'm with you guys. I mean, what you described was essentially what happened in the Nikkei, right? From the
Hmm.
80s till recently.
Oh,
Um,
you slipped Japan in. Good for you.
I had to, I got to, man. Um, it's that would do a lot of damage. I think um, this market's a lot more resilient. I think the access to the ability to invest, technology, um, and just sort of the perception of the market now. Um, it it's not that I'm saying markets are different, but a lot of the things going on within the market and around the market are a lot different now versus 100 years ago.
The last thing I'll bring up is we sort of have our back of the envelope sort of, I don't want to call them recession indicators, but it's things we watch. Things like the high yield spread. High yield spread, meaning the yields on high yield bonds over your treasuries, that difference, that spread. I mean, they've come off the recent lows, but they turned back down. I mean, they're 2.88% or 288 basis points right now. We met with our friends at State Street and Blackstone. Was it 2 days ago? And they quoted research that J.P. Morgan put out that high yield default rates, I think, were sub 2%. and recovery rates, meaning how much they recover. If a bond goes bad and it goes to bankruptcy, like how many cents on the dollar do you recover? I think the recovery rates were pretty decent. Like if this economy was really falling apart, I would think you'd see the default rates come up a little bit, or high yield spreads. And so even though the market was off today, if I look at some of the high yield vehicles that we use in some of our strategies, I mean, it was very small move today in high yield to the downside. So I don't know. I mean, I feel like sentiment is so I like soft data is much worse than hard data. Sentiment is much worse than the hard things that we're seeing. So I don't know, Mike. I mean, I feel like we beat this horse to death, but
Who's wrong?
who's wrong? Who's wrong? All right, let's go to recommendations this week. What do you guys got, Shane?
I'm gonna have to go if you're into like murder mystery, investigation, crime. Fargo. Watch it for the first time with the wife this week. Awesome movie. Won 2 Academy Awards, I believe, for writing by the Coen brothers, and then the actress won Best Supporting, even though she was kind of the main, But great movie. I still got to do Good Will Hunting. I'm gonna get it done. But yeah.
Yeah, I can't wait to see what you think about that one. So this Coen Brothers Fargo, 1996, 7 Oscar nominations, winning 2. Frances McDormand, as you mentioned, for best. Oh, she won for Best Actress and Best Original Screenplay. I think it was nominated for Best Picture, Best Supporting Actor, Best Director, Best Cinematography, and Best Film Editing as well. They did not win those. Yeah, I mean, I thought Fargo was great. I thought the music was great. And I was telling you, like, that movie just took off.
Oh,
And
yeah. It goes from 0 to 100 really quick. And,
I just mean in sort of the zeitgeist. I mean,
you're
in
saying like,
popular culture. Yeah,
man,
like it,
yeah.
because that was an independent, that was a small movie. And I think what wound up happening is a lot of stuff got greenlit afterwards that were these more independent-y type movies. So
Interesting. That's awesome. I mean, the being in Minnesota and North Dakota, like I've been out to both of those states, and if you've been there, it's cold and it's flat in a lot of the places, but there's very specific accents out there, and they all nailed them. Like everybody in the movie just hit it perfectly. I
what
was
was that?
very
The You Betcha,
yeah,
that thing?
oh,
Like,
back and forth. Yeah. Yeah.
yeah, I mean, you Chicago guys got a little of that. There's
Oh, we've got of course.
yeah, there's different dialects. So all right, now that's a good one. I'll put a buy recommendation on that one. Mike, what do you have?
The Beast in Me on Netflix. About, I think I'm 3 or 4 episodes in. It's with Claire Danes and Matthew Reese. Claire Danes is a writer who moves next to Matthew Reese's character and starts writing a book about him. He may or may not be a murderer. So she's trying to toe the line of getting close to this person she's writing a book about, but also wondering if he killed someone.
All right, a strong buy or a buy?
It's just a buy.
Okay,
It's good. Yeah.
okay, all right. Well, that's Claire Danes was in Homeland, and
Yeah,
that
and her character is in some ways, maybe that's just how she acts, but her character is kind of similar. It reminds me of her Homeland character.
Homeland was great, and I didn't watch that from the start. So my wife and I started watching it. We had all the episodes, and I couldn't imagine like having to wait a week when one of those episodes was done. But the problem is, you start watching it, and all of a sudden it's 2 in the morning, and you're still watching it because you just keep going. So Homeland's pretty good.
Yeah, that's one you can't stop watching
No,
once you
it's
start.
very good. I'm trying to remember. I watched something when I was on the plane, but now I can't remember it. So it probably shouldn't be a recommendation anyway if I can't remember it. So that's but yeah, like if anyone hasn't seen Good Will Hunting, and that includes you, Shane, because I want to hear your thoughts on it. You should really watch that this weekend. So I did see the movie Miracle was on the other day because we're getting towards the Olympics. So, and that's always a good one too. I'm not breaking any ground here, but did you guys hear though that the Olympic hockey venue isn't even finished yet in Italy, and they
Yeah.
constructed it to the wrong dimensions? Have you heard that, Mike?
Yeah, I saw a picture of it. It does not look good. I mean, I can't believe how far behind they are just doing this last minute like this.
How did they mess up the configuration? Like you could have just gone online and seen, what are the measurements of a hockey rink?
I have no idea how they messed that up. It's not NHL size or international Olympic size. It's just some other size.
Some other size. It's I heard a press conference. Gary Bettman, the commissioner, and who's the president of the Players Association? Daly. What is his name?
Bill.
Yeah, Bill Daly sounds. Sorry, Bill, if that's if we get your name wrong. But he was pretty explicit. He's like, look, if the ice isn't right, we're not going. And I think Bettman kind of elaborated on it. He said they're concerned they haven't made ice yet, and they want to make sure the ice is good quality and people aren't going to get hurt on it. So, like, what do they do if they can't play the Olympics there? Do they move it somewhere else? Do they just not play and the NHL just says we'll do our own, 8 nations tournament or something like that? Like,
And then amateurs play.
well, I don't know who plays. Maybe they just
Yeah.
pull out of it and they do a rival tournament.
Lace up, Mike.
No, but Shane, like, let's say it's the United Center. I was going to say Chicago Stadium, but the United Center. Let's say they had the open dates. There's no concerts or anything, and the NHL came to them and said, "We want to play, 8 different. We're going to play 3 or 4 games a day, 8, 10 teams, however many teams do the Olympics. We're basically to do the Olympic tournament."
Cup. Yeah, we're doing the FIFA World Cup here soon. So I mean,
but you could do that. You like
anywhere. You could even get the NHL to probably sign up for it, and you just figure it out. Yeah, it'd be a logistics nightmare.
But they could do it on the dime. I mean, as long as the venue's open, they could go to Chicago. They could go anywhere.
Absolutely. And honestly, at that point, I don't even know if they're worried about selling tickets. So realistically, you just need a regulation sized rink and the ability to put up some TVs and cameras.
They could put, No, I mean, they of course they can sell tickets. Like, of course, not only would they sell, it would be easy for them. Like, this is,
yeah.
I mean, so to me, if they can't actually play in Italy, like maybe you do it in Toronto. You do it in Toronto, you do it in like, Chicago, or you could do it, Montreal and Boston again. They just did the 4 nations there. Yeah, I think you'd want a Canadian venue for sure, because that would be. But yeah, to me, like, you do it close to each other. I mean, or Toronto, Detroit. There you go. Toronto, Detroit. You probably do it because they're close to one another, and you can run those. So I don't get it, and I think Gary Bettman was frustrated, but he's kind of like threw up his hands and says, look, we have nothing to do with it. We're trying to help them, but they don't necessarily have to listen to us. So, all right, for our Canadian listeners and our hockey fans, you get a little hockey there. So I'll find out more there. Anything else on the markets? I mean, I think we're going to start getting some news next week. Some of the old data that's going to come in. I think that will come in, and then we got, the Christmas holidays. So start to get into that dead period of trading. Although 2018 certainly had the Christmas Eve bear market that ended on Christmas Eve. So we'll see what happens. All right, I got nothing else. Thanks everyone for coming on. Always come on. Thanks for listening, I should say. And we'll be back next week. See you, everyone.